All right, we just showed you the immediate reaction, and now we want reaction as to how this impacts you and your investments. And we're talking about, like, is your next mortgage about to be that much higher? How about your car loans? Is your credit card rate about to adjust in a way that's not going to be good for you? Is it going to increase? Here to discuss the new rate landscape and what you might see and feel looking ahead, National Alliance global strategist and head of fixed income, Andy Brenner, along with MarketWatch markets editor, Mark Decambre. Andy, tell me, you look at all of these things, particularly when it comes to high yield or all kinds of yielding issues and fixed income. Where will people see the most obvious moves and reaction?
Liz, actually, I'm going to take it the other way. Where they're going to see the most moves and reaction is going to be in the mortgage rates, because what the Fed did today was an absolute disaster. And what it's going to do is send long rates down, which is the antithesis of what they're looking for. You have is looking at your screens. You have the 30-year now down to 3%. You have the 10 years down to 275, 276. This is going to be viewed as a disaster. It's going to crush the equity markets, and it's going to lead to lower long-term rates, and it's going to lead to a flattening yield curve. So your mortgage rates are actually going to get better. But as far as consumer loans, they're going to go up a little bit. But you know what? Who borrows money at 18, 19% credit card rates? I guess people do. I don't. But it's mortgage rates, and those are going to go down because of the massive mistake the Fed has made today and looks like they're going to make all of next year. I mean, come on, Liz. They're talking about inflation being normal or being right around 2%. You just had a 40% drop in oil prices since October 3rd. How is inflation going to stay at 2%? You have deflation. So I think the Fed made a massive mistake here.
Okay, maybe it's disinflation versus deflation. By the way, it's a fancy term for saying a slowing in inflation, Mark. But give me your perspective here. Will student loan rates, Andy just talked about credit card rates. Where do you see the real movement from a quarter-point rate hike that happened today?
Look, the prime rate,
on, Mark.
which...
Mark.
Oh.
Yeah, I would, even take it further and think about just the rate hike, but just look at the market setup. The market is getting obliterated, and individual investors, institutional investors are all getting crushed. As a lot of people have said, it doesn't seem like the Fed is picking up what the market is putting down. And that's going to impact retail investors most directly.
But how do you square then, Mark, with a very solid labor market that is so tight that there's a labor gap, there's a skills gap, and a lot of these jobs are going unfilled because people can pick and choose now? This is sort of a dream scenario, certainly when we had fewer jobs being created, and President Trump promised jobs, and he came through with those. So, I mean, are we supposed to look at just what makes investors happy?
No, I think partially as well as some demographic issues, too. You've got a workforce that's moving from an older demographic to a younger demographic. So some of that is impacting and maybe queering some of the inflation reports, because people who are younger are going to be paid a little bit less. But on a net basis, there's a lot of uncertainty in the market. There's a lot of uncertainty about the economy. That's what's reflected right now in this 440-point decline in the Dow.
Andy, you're saying that the Fed has made a massive mistake. Let's zero in on why. What specifically is the worst thing the Fed did today by raising a teeny tiny quarter point?
Liz, it's not what the Fed did today. We can stomach that. What we're looking for is what the Fed's going to do in the future. And we were looking for a dovish rate hike. In other words, talking about maybe going neutral. I personally think the Fed is done. And I think whether they like it or not, they're not going to be able to raise rates all of next year. And, keeping the balance sheet being reduced at $50 billion a month, I think is just crushing liquidity. And look at your equity prices.
So President Trump is right on that.
I doubt the balance sheet reduction is actually crushing the market. I think ultimately you're talking about a Fed that really had no good options. If they raised, which they did, and indicated that they were going to be accommodative, which they did, the market was still going to go down. That was almost baked in the sauce, and we've seen this play out. In fact, past FOMC meetings with Powell, having led the news conference, have typically led to lower lower levels after his news conference for whatever reason. But there are very few scenarios. The Fed had to thread the needle here.
Let me just say, heavy machinery is in a bear market, and you just look at the transports here. They're down nearly 4% right now. This is a big loss for the trannies, I would have to say, down about 322 points. I want to get a little wonky here. Talk about the prime rate, Andy. What about HELOCs, home equity lines of credit, and things like that? Anything that's tied to prime, how will that be affected?
Everything that's tied to prime will go up 25 basis points. But if I could respond to what Mark said,
sure.
You had a quantitative easing that of basically $4 billion that was a huge uptick in the equity markets as the Fed was buying treasuries and mortgages. It was going into equities, and you had a massive equity rally. What do you think is going to happen when that reverses? That is reversing now. That's quantitative tightening. If it went up because of what the Fed was doing, it's going to go down because of what the Fed is doing. I mean, Gundlach yesterday in his interview said that it was worth 300 basis points what the Fed did. And that's in addition to what the Fed raising rates, just the balance sheet alone. So you're reversing this. This is a huge drain on liquidity. It's a huge hurt for the markets, and that's what we're seeing in equity markets right now. And we'll probably be down another 1,000 points tomorrow.
Yeah, on balance, I don't disagree with that point. I just think that the markets are very fragile right now because we've had 10 years of unprecedented monetary policy.
So, Andy, should the Fed focus on U.S. market conditions, U.S. market chop/volatility, or the whole picture? Because if you look at the whole picture, there's always going to be some hotspot on planet Earth that gets everybody nervous and says will cause uncertainty.
Liz, the global economy is going down very quickly. You had 4 or 5 different economies in the last week show negative GDP growth. Germany. You have weaker growth in China. You have weaker growth all throughout Europe. Liz, the whole world, we're an island. And now, our economy is still showing good numbers, but that's looking backward because of the tax cuts. Looking forward, things don't look so good. And I think the Fed's got to recognize that. And I think the markets are way ahead of the Fed, which is why I think the Fed made a major policy mistake today.